All right, good afternoon, everyone. I know the first session after lunch is very difficult, but this is one of the most interesting strategies that we have with Cordiera. We're going to talk about whiskey aging and marinas and a couple other great ideas. So I'm Sasan Faiz, Managing Director of Investments at Morton Wealth. We're happy to have Ashley Marks, co-founder and co-managing director at Cordiera Investment Partners. Cordiera is an alternative asset manager headquartered in San Francisco. We've had over a decade-long relationship with them, and they invest in these off-the-beaten-path type investments, which we like, the way they source these strategies and the way they do their due diligence. So Ashley, before starting Cordiera, you were a partner at McKenna Asset Management, and you were the portfolio manager for the McKenna Real Estate Fund. And you have an MBA from Stanford, but more importantly, a bachelor's degree from Michigan. So fellow Michigan grad, go blue. All right, awesome. And so,
by the way, this is not Scarlet. This is not. This is never.
We know, go blue.
It's maroon.
Groom, yeah. So, actually, Cordiera's emphasis is on niche alternative investments. Can you maybe explain what that exactly is, and why did you guys think that was attractive to begin with?
Great. Well, thank you for having me, first of all, and thank you for being a great partner over the years. We think of niche alternatives, frankly, as alternatives. And we believe if you can invest in niche alternatives, you can unlock the original promise of what alternative investing was supposed to be and what it had been historically. Which that really means is finding areas where institutional capital has not already competed away returns or bid up pricing, where you can get excess return per unit of risk, and finding areas that are not correlated from a driver perspective with the rest of your portfolio. If you can do that, you could drive returns up on your portfolio and have a much more stable portfolio in periods of contraction. And that's kind of the panacea of all investing and alternative investing. The issue with alternative investing today is that every institution, every pension fund, every endowment, every foundation invests in private equity, real estate, natural resources, hedge funds. And so what used to be called alternative is no longer. And we would argue in a lot of those areas, returns have come down, correlations have come up. So we, in a lot of ways, think we're just going back to the basics of what alternative investing was always intended to do: find these niche areas, invest before the rest of the herd comes, get outsized returns that are uncorrelated to the rest of your portfolio. And that's why we would argue you should have those in your portfolio.
All right, great. So I think one thing we like about Cordiera is, again, non-correlation to traditional asset classes of stocks and bonds, but also the individual investments are non-correlated to each other. But there are broader themes that they may fall under. For example, I was just at your conference in Lexington, Kentucky, and you were talking about this specialty inventory finance. And under that umbrella, for example, is whiskey aging. Maybe you can talk a little bit about that broad umbrella, what it covers, and then a little bit about the whiskey aging strategy.
Yeah, I think when people look at what we do, they say, that's weird stuff, how do you even do it? And what you'll start to notice, and what I think Sasan is referring to, is that these things can start to be bucketed in various different areas, and Cordiera has always had a focus on certain areas. One of those areas is inventory finance. And the reason that we think that we can generate outsized returns that are uncorrelated is because we have patient capital that we can infuse into a supply chain that is oftentimes fragmented, where the other constituents within the supply chain are in the need of quick inventory turns, or don't have access to patient or long-term capital. So a good example of that, we've invested in whiskey, which I'll talk about briefly. We've invested in broadband spectrum, which again, you can get me afterwards and if you want to talk more about these. And we've also looked at things like cheese financing, precious metal lending and leasing financing, which would all fall under this category of inventory finance. With regards to whiskey, we started investing in whiskey in 2018. So we're over 6 years of investing in the space, almost 7 or 8 years now. When we started investing in whiskey, there was a disruption in the industry. What had happened is that demand for brown spirits had been going down for years and years. As a result of that, distilling capacity had been taken out of the system. Then we saw, right on the heels of that, the bourbon boom, which seems like someone has some whiskey right here, so maybe you know about the bourbon boom. No, I was just kidding, it's iced tea. But the point is starting in the early 2000s, what we saw is the demand for brown spirits go up significantly. That, combined with the fact that there was not enough supply, there was a big supply-demand imbalance, and that's really areas that we like to kind of get into. In addition, it had been an industry that had been vertically integrated, but because the disruption prior to the 2000s, we started to see that industry become very fragmented. What that allowed us to do is come in and provide our patient capital, our balance sheet capital, buy new fill whiskey, which is essentially moonshine. We don't suggest you try to drink that. We take it, we age it for 4 years, and then we sell it to craft brands at the prevailing rate on a curve that was, for that reason, because the supply-demand imbalance was at its steepest it had ever been historically. Long story short, we won't get into too many of the nuances of it. That was a very successful program for us. We invested in about 18,000 different barrels. We've sold about a third of those at 2.7 times and gotten 100% of our capital back. So that's just an area of where we've been able to kind of marry our patient capital and inventory finance in a more niche-y, weird, off-the-beaten-path opportunity set.
All right, great. So I'm not a whiskey drinker, but now I think now I can tell the difference between 2-year aged bourbon and 6-year aged bourbon. So much better.
Yes, indeed.
Let's talk about another area that you've been involved with, boat marina integration, and it has been a really great strategy. And what attracted you to that investment, and what is the exit strategy for that investment?
Yeah, you know, when you peel back the onion of boat marinas, it's not that dissimilar to real estate investing. And so when you look at it, what drew us to this was a confluence of factors. One, there was significant barriers to new supply. So I don't know if anyone here, you do live closer to the coast than I do, but if you were to try to build a new boat marina, you would be facing about a 7-year timeline. You'd be facing the EPA. You'd be facing a debt market where you cannot get any financing. And so it has been very, very challenging to build new supply of boat marinas. As a result, it is a very supply-constrained market. On the demand side of the equation, you have the fact that people, at the end of the day, need to park their boat somewhere. We were very concerned about the pro-cyclicality of boat marinas, but once you start studying the earnings of the boat marinas, it's incredibly sticky income. Despite whether or not people are boating, they need a place to park their boat, number one. Number two, if you don't pay your rent, the boat marina can actually repossess your boat and use it as collateral. So at the end of the day, people pay their boat rental. So what we found was a very interesting dynamic on the supply and demand. With regards to the capital markets, there had not been institutional capital in the space. We started investing in 2015, and cap rates, if anyone's familiar with cap rates, the inverse of a multiple, were trading at north of 8%, even up to 10%. If you look at at the time in 2015, if you looked at similar categories of real estate, multifamily, hotels, storage, they were trading well south of a 5%. So that delta between the 5% and the 8 to 10% was because it was quote unquote pre-institutional. And so we thought it was a really interesting place to get into. We always partner with an operator. This operator had been in the space historically, and so we essentially invested in an operator to aggregate a strategy of 30 different marinas, increase earnings on the top line by putting institutional ownership, take out excess costs by just having professional ownership, and create a portfolio of these assets where you can get financing, because banks will look at a portfolio and say, listen, you don't have the idiosyncratic risks that you would have on one individual asset, but since you have 30 different assets located across the country, we're gonna give you financing. The same thing with insurance. If you try to get insurance on one individual boat marina asset, very hard and very expensive. If you diversify it across a portfolio of assets, you can get much more attractive insurance. So in 2015, we dove into this opportunity. We helped finance an operating company. Since then, we've grown that company to about $3 billion. And hopefully, we'll be looking to sell that sooner rather than later. So that's just a good area, again, for looking for things that are pre-institutional. They're pre-institutional, therefore you can get in at a good cost basis and find things that don't act like everything else. In fact, during the recession, during periods of inflation over the past 10 years, we've been able to push earnings about 6%.
That's great. And I know that Blackstone just acquired the largest marina out there. So you think your aggregated marina assets are better quality, but it's second largest right now in the U.S.?
Yeah, so Safe Harbor is our competitor. We're Suntex. You might have heard of them. They actually have a few assets in the area. The largest competitor just got bought by Blackstone at about a 5 cap, which is a tremendous cap rate for that portfolio. So now we are looking at the opportunity. We could either monetize it, we can look to get in additional strategic capital or continue to grow it. This is one that, as you know, we're a private equity fund. You all are investors that are invested in something for longer term and looking for appreciation. And so we are trying to figure out ways that we recognize that our clients do like longer term holds. So this is an area that we might be moving into a CV, a continuation vehicle, so our clients can continue to hold it. But we're not going to have a lack of opportunities to monetize this one.
All right, great. And I know recently sports-related investments have become a big focus for Cordiera. Obviously, when you talk about sports-related investments, you can go buy a small percentage of Dallas Cowboys, but I mean, that's already very expensive.
Who would want to do that?
Yeah. So you guys are kind of looking either, Gus Araya, your partner, was here last year, talked about PTO, Professional Triathlete Organization. You also just invested in the Denver Summit, which is a women's soccer league, the newly launched women's soccer league in Denver. Can you talk about how you came across that investment and why you think that's attractive?
That's great. Yeah, if you, again, taking a step back, because everything we do is under this kind of idea and theory that we're investors in things that are pre-institutional and non-correlated. Again, just going back to why we're doing what we're trying to do. And so if you look through that lens, sports has always been part of our purview. There was a stat I was just reading that the correlation of the big four sports in the U.S. since 1960 is about a 0.2 correlation to the broader market, which is a very low correlation. So I think probably all of us can kind of get behind the theory that we watch sports, we attend sports, no matter what's happening in the economy. So I think, one, it's uncorrelated. And then two, there's definitely certain pockets within sports that are less institutional. I would argue that Dallas Cowboys is not one of them. So how are we at Cordiera looking for those quote-unquote pre-institutional spaces? We have a thesis around 3 different areas within sports. First is emerging leagues and teams, and if anyone heard Gus speak last year about PTO, that's the Professional Triathlon Organization, that's where we provided growth capital to a triathlon organization that's creating like a Grand Slam series of triathlons, both on the men's and women's sides, going around to various cities across the country. And I would say think of that more as a growth capital versus venture, because that has been off the ground for about 5 to 6 years now. So that's the emerging sports and leagues. Then we have a thesis around women's, which I will come back to. And then finally, we have a thesis about the picks and shovels supporting sports. We're seeing a lot of capital come into these spaces. We're seeing continued demand. And so there's a lot of ancillary businesses around sports that are going to benefit. For instance, we're at a late stage of due diligence on a law firm in the UK that is sports only. What's interesting is you can't invest in law firms in the United States, except for in Arizona. It's very niche-y, but you can in the UK. And so we are under late stage negotiations of that law firm. We think that'll really benefit, again, from this kind of rising boats on the sports side. Coming back to women's, we believe women's sports in general is at an inflection point. We've seen the demand for women's sports in the U.S. Go up over 300% over just the past 2 years, and is expected to reach about $2.5 billion in 2025. This has really been driven by a combination of sponsorship, media rights deals, as well as viewership. And that it's really that underlying demand that is making us interested in women's sports, and there's still a lack of institutional capital within that space. In fact, I was at a conference, And it was a conference on all different factors. And there was a sports panel, and the room was full of investors. And the minute the women's sports panel came on, which I was on, half the room got up and left, which was great because it means that there's still opportunity, and we're just going to go ahead and sell to those people that left the room. But anyway, so the basis for our underlying investment thesis is this demand. Specific to your question on what we've invested in, we just invested in the Denver expansion team, which is now formally called Denver Summit FC. We're a 5% owner of that team and on the board. The thesis behind that really is twofold. Number one, we believe that the NWSL will continue to grow at modest growth on a future basis, both from a commercial side and a valuation side. And I will talk to you more about that. And number two, we think Denver's team, both management and ownership team, is uniquely capable and uniquely positioned in order to compete at the top of the league table. So I'll come back to both of those. First, on the NWSL. The NWSL, if you're not familiar, National Women's Soccer League, was actually started in 2013. It was the third try for women's soccer in the United States. It currently has 16 teams, and it's going to 20 within the next few years. It is what we call a closed league, so it's not subject to relegation. That's important if anyone knows anything about English football or what's happened over in Europe, and that's it's a big distinction on a risk metric. You cannot get relegated in the United States. And they've experienced incredible growth over the past 3 to 4 years. In fact, there was over 2 million people that went to various different games in the NWSL last year, and about 20 million people viewed it on linear television. This was about a 5 times increase from just 2 years prior. So we're seeing real growth there, and that's, again, underpinning a lot of our analysis. That said, it is still significantly under-commercialized from multiple perspectives. Number one, all the dollars going to sports today, only 15% are going towards women's sports. From a media perspective, only 20% of the dollars are going to women's sports. And you kind of say, okay, well, that might seem right. There has been multiple studies suggesting that the women fan, the person, not a woman watching, but the fan of women's athletics are a better consumer. And what I mean by that is they're 54% more able to have brand identification when it's been on a jersey, and they're 45% more likely to actually transact with that brand. So at the end of the day, you want to be going after those consumers, yet they are still commercially underrepresented from both a commercial sponsorship and media perspective. So our thesis is those are going to continue to grow, even if the pie for media and pie for sponsorship might be decreasing. So those are the kind of underpinnings for more of a macro level. Why Denver? Denver is a soccer town. Denver has 3 of the top 20 national team players, and which suggests that it really has kind of a grassroots operations within Denver. Number 2, the ownership group. Rob Cohn, who's the controlling owner, ourselves, and then Melody Hobson, who's project level, ex-chairman of Starbucks, husband or wife to George Lucas, side note. But she's also in the capital stack alongside us. And what that means is that we have real investors that are looking at ROI, and this is not a passion project for any of us. And that actually makes a significant difference. Finally, the city is behind it. So both the mayor and the governor have both put out their flags saying that they will support the city. They will support it so much that they are going to be contributing land so we can build a stadium. So it is a combination of getting the right league, getting the right market, and getting the right team. And that's our investment in Denver.
So great. Maybe in 2027, we can have the Cordiera conference at the
2028.
28. All right. So we have a couple minutes left. I just want to see if there are any questions before we have some. Yes, please. No, Costa Noa was actually bought by an institution. Costa Noa was one of the first glamping sites. You know what? I actually thought it was a private equity firm, but you might be right. It is an interesting, the barriers of entry, I'm not totally sure about. Frankly, we have not looked at it, but that's something we would absolutely look like. And then we just have to get convinced of the supply demand.
RV parks are very, very similar to boat marinas. That one is too institutional for us, and it was a great play and actually something I invested in when I was at McKenna, and we saw cap rates come in there. Sun Communities was a great example of that, and that was exactly, you're on to exactly what we're trying to look for. That one just has been arved away. Glamping, I got you. I'll give you rights on that one.
Yes, we have a couple more questions here, please.
Yeah. Yep.
So how do you protect that investment, knowing that you've got to, when you put it in the barrel, it's got to be in there for at least 2 years and probably 4 in your case. So how do you
It's a great question, and we have seen that contraction. I would say two things. One, we invested in 2018. We have not been buying since then. So that's the first thing. And we already have our cost basis. But to your point, what are you doing with that 12,000? We have entered into forward contracts with a few different companies to take that risk off the table. So once we started seeing that demand decline, we entered into forward contracts and we've moved on. So what Sasan has mentioned before is that we're no longer buying barrels in that market, and our basis is very good in that. So we'll still make money. So what I would say is the pricing curve for 3 to 4 year whiskey, when we invested in it, it was close to 3,000, 4,000. Now it's closer to 2. So we'll still make money. It has come down, and we've also entered into forward contracts to secure that 2x, if that makes sense. And then most importantly, we have moved on. And why one of the whole reasons that we're doing what we're doing is because we saw people do these asset classes. And once you've invested in something, even if the returns come down or the demand goes away, you have to keep investing in it. What we love about our strategy is we move on. So one area that we moved on to is Scotch. Scotch has some really interesting dynamics on the kind of later end of the curve. So we're in at the 20 to 40 year versus the front end of the curve, which you can't do in whiskey, which sounds like you probably know. So just from a very high level, monetizing early, reducing your basis. We did that at the 2.7. We locked in forward contracts, and then we moved on.
So I think we're over time, but actually maybe you can stay around for a few minutes.
Yes, I can. Happy
All right,
to.
then we can have some private conversation. Thanks everyone
Great.
for attending, and enjoy the rest of your day.